Hello, good people. How are you? I hope you're doing fine wherever you are. I am the ACCA tutor, Mr. Mutikolo Jerry, and in this video, we're going to discuss cash budgets. Okay, so the assumption is that you know the background. We have the background about budgeting. Okay, and when we now talk of cash budgets, you understand what we will be talking about. Remember, a budget is a financial plan. Okay, it's just a financial plan. It assists management to work systematically or to deliver their goals in a systematic manner. So remember, we are inclined towards cash management, right? And the previous videos we talked about the introductory aspects, in cash management, right? And we have covered the differences between cash and profit, and we actually explained why it matters to consider cash more than profit. Okay, but by the end of the day, we are not saying profit is bad or should not be considered. So, cash budgets are likely to be tested in your examination, together with two other models in the management of cash, which are the one is the Baumol, the Baumol model. So Baumol model, and the second one is the Miller-Orr model. These are going to be tested in as much as cash is concerned. So you need to master them. You should always remember them when you enter into the exam hall. All right, so we're going to start with cash budgets. So here we've listed the steps you need to take when setting up or when preparing a cash budget. First of all, you need to have a pro forma. A pro forma is just a table with some headings and so forth. Usually the headings would be the month, as this budget is normally prepared on a month-by-month basis. Sometimes in other organizations, they prepare on a weekly basis. It's up to them, but normally the industrial practice is to prepare the budget on a month-by-month basis. So you need to establish the budgeted sales month by month, right? But you need to bear in mind the credit period taken by customers. Remember, customers are also called debtors. Okay, credit customers are debtors, right, or receivables. All right, and you also have to take into account discounts, right? Discounts allowed. All right, the discounts will allow our customers to enjoy. Then calculate when budgeted sales revenue will be received as cash and when opening receivables, that is the debtors, will pay. Okay, third, establish when any other cash income will be received. Okay, apart from sales, there could be other incomes which could be receivable, for example, bank loans and so forth. They have to be taken into account. Then you need to establish for each month production quantities, enhanced material usage quantities, material inventory changes, and the quantity and the cost of material purchases. Remember, we will deal with we would have covered it in performance management, the aspect of variance analysis and so forth. All right, those are products of budgeting as well. So we need to be able to establish for each month production quantities. How much are we going to produce? Hence material usage quantities, materials, inventory changes, and the quantity and cost of materials purchases. Bear in mind the credit period taken calculate when the cash payments to suppliers will be made and when the amount due to opening payables, that is creditors, will be paid. Right? So we need to compute the cash payments which we are going to make to suppliers, or usually this would have been credit suppliers, which are called creditors. Lastly, we need to establish when any other cash payments, excluding non-cash items such as depreciation, will be paid. Then include at the foot of every column of your cash budget the opening cash position, the net cash flow, and the closing cash position. You need to remember this. All right, so let us look at the pro forma cash budgets for our learning. So like I said, the pro forma is just the table or the template we need to bear in mind whenever we are attempting a cash budget question or simply a budget question. All right, specifically for cash budgets, like I said, you need to prepare this budget on a month by month basis. So as you can see, there is month 1, month 2, and month 3. Those are columns. All right, and we have got these rows, these are the rows. All right, now we normally start with information relating to cash inflows. This is cash that we are receiving. So we have headed this first part, cash receipts. We need to budget for the sales, okay, normally, or for the income we are going to receive. So there is receipts from receivables, which we normally put on top there because that's the core income we are likely to receive. All right, then other income like loans. If we are expecting to receive loans in a certain month, we then have to include those loans, right? And then we get the total of these figures. We then move on to cash payments. All right, we are having payments to suppliers. All right, if you are intending to pay suppliers in month 1, we write there. Month 2, we set there. Month 3, we do the same. For wages, okay, if we are paying, if we have got employees and we need to pay them, we also have to put that one into account. Then we total up. These are the totals. Okay, then remember there was a statement that we need to, this statement is very, very, very important. Okay, include at the foot of every column, your cash budget, the opening cash position. So this is the opening cash position and this is the foot. Remember, this is the foot. Okay, that's the foot of the budget. So the opening cash balance you'll be told in the scenario how much you were having when you enter that particular month. So this is the opening amount, right? Then the net cash flow. This net cash flow is the sum of this total and this total. Okay, and remember this was a positive total and this is a negative total. Those are payments and then those on top are receipts or income. Okay, so the net is actually the difference between, okay, is the difference between the receipts and the payments. You get your difference there, the net balance. Then you add up this net balance to the opening balance and you get your total. So you can just add the opening and the net cash flow, and you get your closing balance. All right. Now, if you have already slotted all these other figures, okay, if you have already slotted in these figures, then the foot is not going to be problematic to you. You just have to understand what will be going on. So the closing balance, this in the first month, this closing balance is going to be automatically the opening balance in month 2. So in month 2, we're going to have the same closing balance of month 1 being the opening balance for month 2. Then for this aspect, you just have to know that it is the net of the receipts and the payments, the difference, okay? And you then have to do the sum and get this amount. Then you take this amount again to become the opening balance for the third month, okay? And then this one is, as we have already indicated, the difference between the receipts and the payments. Then you add up these two figures and you get your ultimate closing balance. Is that clear, ladies and gentlemen? If I have explained clearly, please just type hello say in the comment section to this video. If you haven't subscribed as yet, please do so. Subscribe to the channel, like, share, and comment to the video so that the video goes viral. Now, let us do an example to send the knowledge home. A business is started on 1 January 2020. On 1 January, it purchases materials for $100,000, and the supplier allows credit of one month after invoicing at the end of each month. So at the end of each month, we then start to calculate another month before we make a payment. What does that what does that mean? It simply means that if you purchase goods, okay, if you purchase goods for resale today, that is 20, okay, today 20 July, all right, you don't count, let me just say, your liability, okay, or the payments to creditors will be due not in the next 30 days, but you start to count at the end of July. So which means the next payment or the liability will be due on the 31st of August. Why? Because we have started from 1 August to the 30th. That's the 30 days we're talking about. Are we together? We don't count from the date of sale, but we count from the month end of the month in which the purchases were made. Is that clear, ladies and gentlemen? Good. It takes the business 3 months to manufacture goods, which they then sell immediately for $350,000, invoicing immediately, and customers take 2 months credit. So here we are being told now that immediately when they make a sale, they invoice their customers immediately. They don't wait until the month of sale until the month end of the month of sale to invoice. They just invoice immediately. Okay, so which means the treatment is a bit different from what we're doing on creditors. Okay, great. Now, in March, the business spends $80,000 buying non-current assets. All right, so they are also buying non-current assets. Okay, ladies and gentlemen, I'm sorry, the room is getting darker. I've run out of electricity. I'm sorry for that. Okay, so we were saying in March the business spends $80,000 buying non-current assets. The business cash balance at 1 January 2020 is $70,000. A. What profit does the business make for the period to 30 June 2020? So we are being tested on our understanding of the theory between a profit statement and a cash budget. We need to be able to make a distinction between the two. Right? The statement of profit or loss is a periodical statement. It covers the performance of the entity for a particular period. Okay, this is why it is called, it is usually titled the statement of profit or loss for the year ended, which means for the whole year, okay, to that period. Here, we are also being given the same wording for the period to 30 June 2020. Are we together? So we need to account for this. Since the 1st of January 2020. So it's almost about 6 months now, 6 months performance. Now, profit is normally calculated as sales, okay, sales less what's going on. I'm sorry for my, let me just try to write it here. Okay, so part A, we normally say sales. Okay, sales, we put a figure for sales there, and then we say sales less cost of sales. All right, cost of sales is a compound figure. All right, it is made up of, cost of sales are made up of opening stock, okay, add purchases, okay, and then you get a total. All right, and then you then say less closing stock. All right, and then that closing stock is then going to be deducted. Deducted from the total of opening and purchases, opening stock and purchases. All right. Then the figure we get is normally going to be deducted again, because remember, here we said less because this is the figure for the cost of sales. That's the ultimate figure, that is the cost of sales. Then when we do that, we then come to what is called the amount we are going to get here. Remember, I said this one should be in bracket. So the amount we're going to get there is what is called gross profit. Okay, that's the gross profit. Now, we just assume that there were no employee expenses, or there is no need to differentiate what type of expenses were incurred. Okay, we just bunch those expenses as other expenses. All right. Why are we saying other expenses? Remember, the cost of sales itself, this one is an expense, but it's a special expense. All right. That's why it is differentiated from the rest of other expenses. All right. It's an expense. So we are going to use this as an expense. The rest of the expenses as other expenses. So we are going to use this term. All right. The other expenses are then going to be deducted from the profit which we would have put there. So let us slot in the figures. Remember, I said you just have to have some sort of pro forma in your head for you to be able to answer these questions. So if you go back to the question, we are told that these guys are going to spend about 3 months manufacturing something which they will then sell at a price of 350,000. That's the only information of sales we are told. Okay, so from 1 January to 30 June, they are only going to sell those items, right, which are worth $350,000 in sales value. So 350, we put it on the outer column there. $350,000 as our sales, right? Then let's talk of opening stock. Does the question tell us that they have got certain stocks? Let us read again. Okay, on 1 January, they purchase materials for 100,000. So they started to purchase from 1 January. Okay, we are not told that by 31st December 2019 they were having something. Okay, so if we had been told that one, then it was going to automatically become the opening stock. However, we are not told, so there is no opening stock there. So on opening stock, we put a 0 there, right? Then on purchases, we are told that they purchased something for 100,000. So that becomes the purchases. Okay, so here we say that there was a 0 there. So if we add 0 to 100,000, it still come to 100,000. All right. Then we deduct closing stock. Okay, are we told of any closing stock at the end? Other expenses were that other expenses paid every month amounted to 30,000. Okay, so the other expenses are not the closing stock, they are different. Okay, closing stock are actually assets which were not sold. Okay, so in March the business spends 80,000 buying 9 current assets. Those ones do not come to become current assets like stock. Okay, they are different. They are not going to appear in the statement of profit or loss, so ignore them. The business cash balance at 1 January is 70,000. Yes, there is an opening balance of 70,000, but this one does not affect the statement of profit or loss. Okay, don't put it as opening stock. No, this one is just a cash balance. It's not stock. Are we together? Good. So we are good to go. So all right, so we don't have closing stock. All right, there is 0 closing stock. So automatically this 100 minus that one becomes 100 here, 100,000 negative there. All right, geomathematics, and this is separated from 350 on top there to come to the gross profit of 250,000. Okay, then this 250 is going to be lessened by the other expenses. The other expenses, we are told in the question that the other expenses is made up of $30,000, which is paid monthly. So how many months are we talking about from 1 January to 30 June? We're talking of 6 months. So there is $30,000 multiplied by 6, and this comes to 180,000. So that's the other expense. So the net profit, our net profit becomes 250 minus 180. What is that amount? 250 minus 180, that comes to 70,000. That's our profit. Is that clear, ladies and gentlemen? That is our profit. Okay, now let's finish up the part B. Part B is saying that what is the cash balance of the business at the end of each month during the 6 months to 30 June 2020. So here you are being asked of a cash budget. Nobody is going to tell you that, hey, prepare a cash budget. You are going to lead yourself. You need to hear from the wording of the question. Here the examiner is saying, tell us the cash balance of the business at the end of each month during the 6 months to 30 June 2020. So you are being asked of a cash budget. And I say that this is prepared on a month by month basis. Are we together? Good. So we come here and say, oh, let me just stretch a bit. Good. Let me stretch a bit. So that's part B. Do I have light here? Okay. Part B. So for our part B, we need the information about, you can just call it cash budget. Okay, so we know the period. We started on 1 January. So January, February, March, April, May, June. Okay, we have that information. So we are going to start with the receipts. Okay, our receipts information. We are told of receipts from customers, receipts from credit customers. If we were expecting receipts from normal customers, or let me just say cash customers, if there was information about sales on cash, we're as well going to create a line for that one. All right, but unfortunately for this question, that information is not there. All right, so like I said, the items we are told it takes the business 3 months to manufacture goods, which they then sell immediately for 350,000. All right, invoicing immediately, and customers take 2 months. All right, they take 2 months. Like I said, this one, when we sell, we start to count the 2 months there and there. So we started on 1 January, okay? So which means if we started on 1 January, it means that the production will end on 31st March. That's the end of 3 months, isn't it? These are the 3 months. To 31st March. All right? Good. Then after 31st March, we then give customers 2 months. So when are we supposed to expect, when are we expecting the cash from customers? We are going to expect after 2 months from March, which means it's 31 May. So in May, that's when we are going to expect cash from customers. So in our budget, we come here, we are expecting 350,000 when? In May. Okay, you can just do this formatting in your Excel at the end of the question, right? Because you might run out of time. All right, once we've done that, we ask ourselves, have we been told of any income, any cash coming from the question there? In March, the business spends 8,000, so that's an outflow. The business cash balance that one is an opening balance, so we put that one in the foot of the cash budget. And I've shown you what we mean by the foot. So don't worry, you are in safe hands. All right, so we can total up because there's no other information about receipts. So you just have to total up receipts. These were 350,000. Okay, then you move on to payments. On payments, we are told of the material purchase of 100,000. On 1 January, it purchases materials for 100,000. The supplier allows credit of 1 month after invoicing. Right? So we purchase this on 1 January, yes. But when are we making a payment? So payments to credit suppliers. We are allowed 1 month. Okay? We are allowed 1 month. So like I said, we are given 30 days, but these 30 days start at the end of the month of transaction. So the transaction was done on 1 January, right? 1 January. All right. But we do not count to say, okay, fine, we're going to pay in January because the 30 days are going to expire, from 1 January. So the 30 days expire on 30 January. No, it doesn't work like that. Listen to the wording of the question. The question says, the supplier allows credit of 1 month after invoicing at the end of each month, which means the invoicing, although the purchase was done on 1 January, the invoicing was done on 31st January. Then we count 30 days. Of course, we know that February, which is the subsequent month, doesn't have 30 days. So we just have to assume that the payment is going to be made in February. That's when the 30 days are going to be located. So we are going to say 100,000. This is just the simple trick which happens with budgets. If you don't understand the language, you are going to be dazzled and thrown overboard. Okay, we are then told of the other expenses. Okay, the other expenses information. We are told that this one is paid on a monthly basis, 30,000. 30,000. This time you are not going to lump up the figure. Why? Because each month has to have its own figures. This is now a budget. Okay, that's 30,000, ladies and gentlemen. Do not worry about the poor writing of the tutor. 30,000. 30,000. Okay, then let us total up, ladies and gentlemen. Let's total up these figures. Sure, we no longer have any other figures, so total payments. All right, so in the first column there, we only have got 30,000. Here we are now having 130,000. Here 30,000. 30,000. A clever student should have put the zeros in these dollar signs, the 3 zeros there, so that you won't take much time writing this. So here is 380,000. Is that clear? Is it 380,000? No. Sorry, I forgot to, this is a terrible mistake. All right, I should have double underlined there. All right, to demarcate these figures, they are not related in their direction. So here we just have to slot in the 30,000 as it is. 30,000. Good. So these are the totals again. Let me just double underline. Okay, after doing this, you then have to say, okay, opening balance. Okay, the opening balance is issues. Okay, this is now information about the food, but remember we have got the January, February, March, April, May, June. This is the information about the food. Okay, so we need the opening balance. Remember, it's a continuation. The opening balance, we were told that in the question there were $70,000. There was $70,000 as cash balance at the beginning of the year. Okay, so we need to put that one into account. $70,000. Then we come to the net cash flow, right? We can just use the terminology we used in the example. That's the net cash flow is fine. Net cash flow, all right, which is the difference between, right? This is the difference between the receipts and the expenses. I mean the payments, the receipts and the payments. So the receipts, in the receipt there was a 0, but here we are having a negative 30. The payments are negative, so we are going to have a negative 30 here. 30,000 negative. So what is our balance? The closing balance for the month of January, that's 40,000 positive. All right, then this 40,000 automatically becomes the opening for February. Are we together? That's the opening for February. Then we get to the net cash flow. That's 0 minus 130,000. That's a negative 130,000. Okay, we are having a negative 130,000 here. All right, so remember this is 40,000. So 40,000 positive minus 130,000. This comes to 90,000 negative. 90,000 negative, and this becomes the opening balance. So we are going to have an opening of negative 90,000. Then we do the same, the net cash flow. There was a 0 minus a 30,000 there, so we are having a negative 30,000. This is negative. Okay, negative 90 minus negative 30. I mean negative 90 minus 30. Okay, if you say negative 90 minus negative 30, you are going to get the wrong answer there. Are we together? Okay, you'll be getting 60, but the actual answer there is 120 negative. Okay, so it's negative 90 minus 30. Okay, so that's 120. Here I'm saying that's minus 90,000 minus 30,000. That's what we are talking about. Okay, so the negatives are increasing. So we are opening with the negative 120,000 there in April. Okay, negative 120,000, and in April we are having a 0, and it's again a negative 30,000. So the negatives are increasing to 150,000 negative. Then this 150 becomes the opening there. Then what happened in May in May, we were lucky. We sold something for 350,000. We made a huge amount of money. So 350,000. This is going to cancel almost everything there. It is going to cancel a lot of figures there. Okay, just wait a minute. I'm sure we lost track somewhere. We lost track. We just took the 350 raw as it was without adjusting it to its expense. Okay, we just took the 350 as it was without adjusting it with this particular expense. So we need to get the net payment. The net payment was 350 minus the payments. The net amount was 350, which was the receipt minus the expense of 30,000. So we should arrive at 320. 350 minus 30, that's 320, isn't it? Good. So 320, right, which is positive, is being added to a negative 150. This comes to 170,000 positive. Okay, and in June we're going to start with a positive 170,000. However, there was a zero in terms of receipts in that month, and there was a payment of 30,000. So we are going to further reduce the 170 by 30,000 negative, and this comes to 140 as the closing balance. This is our answer for the closing balance. However, the question wanted us to write closing balances in each month as we did. Is that clear, ladies and gentlemen? I hope you are now masters of cash budgets. All right, so see you in the next video where we'll be talking about the Baumo model. All right, and we are also going to give you another video on the Miller-Orr model, and we seal cash management. The rest of the items you're going to read from the notes. Right, there are a few items which you need to understand about overtrading, overcapitalization, all those things. Those ones are kindergarten stuff. All right, just have to read them on your own. All right, see you guys in the next video. Bye.